Well, hello and welcome to Global Mantra Market Outlook 2015 with me, Tanvir Gill. This is a special series that we bring to you each year from the City of London, speaking to a lot of prominent money managers and market speakers about their views into the new year. My guest today on the show is Joachim Fels, who's the Global Chief Economist at Morgan Stanley. Joachim, it's great to have you on the show. Thanks very much for taking out the time. Let me begin by touching upon one of your recent comments where you said that, an accommodative policy stance is likely to extend itself out for a decade, of which we've just seen 5 years go past. So do you expect that over the next 5 years as well, we would look at monetary easing from most central banks?
Yeah, I think that's right. I think interest rates will stay lower for longer. And I think the main reason is that we are in a situation where inflation, if you look around the world in the major economies, inflation is below target. Right? You look at the US, you look at Japan, you look at the euro area, you look at China, the UK, this country. Everywhere inflation is below central banks' targets. And that's despite the fact that we are now in year 6 of this economic expansion. And I think it's been a very special expansion, a very unusual economic expansion. I've called it a triple B expansion because growth is bumpy, it's below par, it's brittle. And I think this continues around the world. And so if you have a situation where growth is very bumpy and it's below par and it's brittle and you have inflation below targets, then I think that makes for a very accommodative monetary policy stance. So I think the Fed will start hiking interest rates much later than the markets are currently pricing in.
Much later would be when?
Well, much later means sometime in 2016. The markets are now priced for the second half of 2015. We think the Fed will probably take until, say, the first quarter of 2016 before they start hiking interest rates. And even that may be optimistic.
Right. So you do know that you're among the minority on that view. How do you then rationalize a change in Fed policy in 2016 when you're talking to a lot of your clients, as most people on the street believe that mid-2015 to end 2015 is when we're going to be seeing a move by the Fed?
Yeah, there are basically 3 reasons why we think the Fed will start later. The first reason is we think that the Fed's own growth forecasts for next year are too high. So the Fed expects something like 3%, maybe even more than that, GDP growth next year. We think we'll be closer to 2.5%. That will still be better than the last 5 years, but I think this will be a very moderate economic expansion next year.
Which means there will be no growth on a year-on-year basis, because 2015 also the expectation is roughly between 2.2 to 2.5% growth.
Yeah, that's right. Well, this year we started from a very low level, right? The first quarter was even negative. Now we have a pickup, but it would be no further acceleration from the recent pace in 2015. So in the third quarter of this year, in the fourth quarter, those 2 quarters together will probably have seen 3% growth. Part of this is the catch-up from the very low first half. Next year we are at roughly 2.5%. So no further acceleration in US growth. That's the first reason.
Sure.
Second reason, inflation. As I said, we are below target. We think that with the recent drop in oil prices and with no signs of wage growth or wage acceleration in the US, you'll see core inflation running below target until sometime late next year. We're at 1.5% now for core inflation, and we think we'll only get to 2% at some stage in 2016. And then there's a third reason, and that's the dollar. So we think the dollar will continue to be strong, will appreciate further. This is because Japan, Europe, and some other economies are trying to export their own deflation via currency depreciation. The dollar is appreciating, and that means the US is importing disinflation or even deflationary tendencies. And that means inflation will stay low, and so the Fed can be patient.
But here's the thing about inflation. Another view is that, while we were in a phase of quantitative easing, that was pretty much the impact phase when the market was, injected with this liquidity, when the economy was injected with this liquidity. Now we are sort of entering the adjustment phase where all this money will find its way into inflation. So maybe 2015, come 2016, we would see a pickup in prices.
Well, I think there are 2 things that we would need to see first before inflation picks up. The first one is I think we would need to see a much faster pace of credit expansion. So far we haven't seen that. So yes, there's a lot of money in the system, but it's largely bottled up in the banking sector. and the banks haven't really started lending out to any large extent. So credit growth very subdued, and likely to remain very subdued because US households are very much in savings mode rather than in spending mode. And then the second thing we need to see before inflation picks up, I think, is an acceleration in wage growth. And so far there are no clear signs that wages are really accelerating.
So you're not worried about the situation that may come by from Europe? Do you think that deflation is a real risk for Europe that could impact world markets, especially the US, given that it almost appears that the economy and the markets are in a steady zone?
I'm actually a little bit less worried about deflation in Europe, or the deflation risk, than I was 6 or 12 months ago. So back then I thought there's a real risk of Japanification. I think what has changed is, first of all, the euro has depreciated. So we've gone from 140 to the dollar to something like 125 recently. So this will help on the import price side. This will push prices higher. Secondly, the ECB has made big progress in what they call credit easing. So they have helped the banks to repair their balance sheets. Various measures that the ECB has announced recently, like covered bond purchases, ABS purchases, and also very long-term financing for the banks, the TLTROs. I think this helps the banking sector to clean up balance sheets and to start lending again. And then thirdly, the ECB is now starting to expand its own balance sheet. So they are starting to do QE European style. And I think this will help inflation expectations higher, and it will probably also push the euro lower.
And do you think that will pretty much support the market as well in Europe, which has been a bit depreciated? The market has given negative returns this year, primarily on account of lack of commitment that they've seen from the ECB. Do you think that could change? Overall sentiment on Europe could change because, midway through the year, people would realize that we're not going to be perhaps looking at a negative number on prices, on the prints.
Yeah, I think that's exactly right. I think markets have become, and many investors have become, too negative on the European equity market. I think if our forecast is right and we see a moderate recovery and we see more balance sheet expansion from the ECB, it will help equities. This is what we saw in the US, this is what we saw in Japan when their central banks became more aggressive. It usually leads to a re-rating of equities, and that's exactly what we would expect in the European case as well.
The other concern is falling oil prices. That would continue to keep downward pressure on inflation. What do you have to say to that? How do you think that would have an impact on the numbers?
Yeah, I think if oil prices were to fall further, we do not think that we will get a further sharp drop. But if that were to happen, clearly it would push headline inflation lower. And then I think we could really see maybe even a negative print on headline inflation. But the one thing I would keep in mind is that lower oil prices benefit consumers. So in that sense, it would actually help the real economy. It would not be as bad news as a drop in inflation or even deflation caused by a shortfall in demand.
Well, what is the probability that you ascribe to that happening now, as we close out 2014, of seeing negative prints on headline inflation in Europe? And how do you think world markets would take to it?
Yeah, well, I think given how low we still are on headline inflation at 0.4%, the probability is maybe something like 20%, maybe even 25%, that we see a negative print. And I think markets would take it badly.
You believe that it could bring about a fairly significant sell-off in markets?
I do think so, because negative headline inflation, I think, would remind people that Europe is in a very high risk of falling into a Japanese type situation where these things become self-fulfilling. So when inflation is negative, people will hold back spending, and then the economy declines further, which means prices go even lower, so you might get into a vicious spiral.
So you see the deflation risk as a bit of a blip. You do not see it as a structural issue that can fracture market sentiment.
I think deflation would only become structural if the central bank doesn't react. But I think if we fall into mild deflation, you would get a reaction from the ECB. In that sense, I think it would be temporary. I think they would not wait as long as the Bank of Japan did in the late 90s before they take action.
So you're saying there are not going to be rate hikes in 2015 by the Fed. You're saying that deflation is perhaps not as big a risk as people are making it out to be right now. What about a big dollar rally? Do you think that we're in for something like an Asian crisis where the dollar just zooms past everybody's expectation, and you see emerging market currencies at the brink of significant depreciation?
Well, I think first of all, we think there will be a significant dollar rally. So the dollar will, we think, strengthen further as we go through 2015.
Do you have a target there?
Well, it depends on which currency you're looking at, but for euro
The
dollar,
dollar index rather.
for the dollar index, I think I don't have the number at my fingertips, but my guess is that we're looking for at least another 7% trade-weighted appreciation of the dollar. Something between 5 and 10%, I think maybe about 7%. And some of these are quite big numbers. So euro dollar, for example, we see going to 112 in the course of the next 12 months.
Okay.
So what would it mean for emerging markets? That was your initial question. I think, again, we have to differentiate. I think there are some countries in EM that would actually welcome some further depreciation of their currencies, because it would help them to switch towards a more export-based system. I think there are, if you look back at last year at the taper tantrum, there were really 5 economies that were in EM that were hit in particular by the dollar strength and the higher US rates. And these were India, Indonesia, South Africa, Turkey and Brazil. Now, since then we've seen quite a lot of adjustment in India. So we think India has dropped out of these group of 5 countries that were most affected. Why have they fallen out? Well, first of all, the current account balance, the current account deficit has shrunk a lot. So India is now less dependent on foreign capital inflows to finance a current account deficit. And second, we have a new government with a pretty impressive reform agenda. So this is why I think investors would now give India the benefit of the doubt. Of course, the reform agenda still has to be implemented. That's the big question mark. But I think, again, investors are going to give India the benefit of the doubt. Plus, third point, India has a very credible central bank. And I think that also helps. So in that sense, I think the fallout, the negative fallout from dollar strength on India is fairly limited. Another economy that has made some progress on that front is Indonesia. Not as much as India, but even there. New government, some compression in the current account deficit, in that sense, less vulnerable. But I think the likes of Brazil, Turkey, South Africa are still very much at risk if the dollar rallies further.
You know, a dollar rally would also mean that people would be betting on rates going up in the US. Or if there is a signal that by the Fed, let's say into the first quarter of 2015, saying that we are closer to hiking rates, then the rate differential would also make it more attractive to buy the dollar. And that would perhaps depress a lot of these EM currencies because there would be a significant amount of capital outflow from these markets. Would that impact the rupee?
Yes.
So there would be a structural reason that the rupee would not fall beyond a point. And we've pretty much been in a tight range all of this year, 61, 62 whereabouts. But if there is a scenario where all emerging markets are faced with capital outflows rather, then would India still be vulnerable? Would the rupee be vulnerable?
I think you really have to differentiate. I think India, given the changes that are outlined earlier, new government, a credible central bank, compression in the current account deficit, I think India stands a very good chance to go against the trend, even if there is a general outflow of capital from emerging markets. But it really depends on what is the driver for the dollar strength. If it is higher interest rates in the US, significantly higher interest rates, then I think everybody gets hurt, including India. India to a lesser extent. But if the dollar strength is rather due to growth differentials between the US and some other parts of the developed world, then I think it's a different story. Because then US interest rates can stay relatively low. The US will attract capital into its equity market, or from companies in the form of FDI into the US manufacturing sector or the energy sector. This would push the dollar higher, but it could actually keep interest rates lower because the dollar appreciation will keep inflation low, and so US interest rates can stay low and the Fed can stay patient. And I would argue that would actually be quite a good backdrop, a good global backdrop for many emerging market countries, and in particular India. Because you get the stronger dollar, yes, but you don't get the higher US rates.
How do you kind of correlate market reaction then across the world? Because you'll have the ECB talking about easing. You are saying that 2015 you are not expecting rates to go up in the US, but let's assume, given the popular view, that rates do go up. The other countries are in an environment of monetary easing. So you have Japan, which is easing. You are talking about rate cuts in India. How do markets really take on an environment which is so differentiated and so divergent in policy stance?
But I think that's a big theme for next year. It has already been a theme for parts of this year, the differentiation across countries. The way we put it is we say the global economy is out of sync and monetary policy is going in opposite directions. I think what matters for the global economy as a whole is what the net effect is. And if you actually add up the balance sheet expansion that the Bank of Japan is planning to do, plus the one that the ECB is going to do, it more than offsets the end of QE in the United States. So I would argue the global monetary policy stance is still very accommodative and will become even more accommodative. In addition to some of the countries or central banks you've mentioned, I would throw in China, where I think you will see more monetary easing, though in a very targeted way, not in a big way in terms of triple R cuts or interest rate cuts, but there will be more easing in a more targeted manner. And you mentioned India. I would throw in maybe Korea, where there's a good chance that we see further monetary easing, given how low inflation is. And then if you look at some of the smaller central banks in the developed world, I think you will also get more easing. So I think liquidity will remain relatively ample.
With more ease on the monetary side, one is not very sure as to how much of the money would actually solve the structural problems in these economies versus how much this money would actually further inflate asset prices.
Yeah, well, clearly you cannot solve structural problems with just printing money. I think we all agree on that. But what you can do with monetary policy is you can buy time. You can buy time for these structural reforms to be implemented. Of course, they still have to be implemented, but at least monetary policy can buy time. And by supporting asset prices, you will get some real economic effects, because if you support asset prices, you are indirectly supporting the balance sheets of corporates and households. Right? As you drive stock prices higher, as you drive interest rates down or bond prices up, it helps indebted companies, it helps indebted households, and it also helps banks to repair their balance sheet. So in that sense, there are some real effects from QE. Yes, it's mainly driving up asset prices, but this will have real economic consequences.
What are the risks that come to your mind? What are the top 3 risks that would keep you awake or have you worried about the scenario that's playing out right now?
Yeah. Well, the first and I think most obvious risk is the geopolitical tensions that we are seeing. Now, we've seen a lot of them in the Middle East, Russia, Ukraine, already in the course of this year. But so far these tensions have not led to an increase in oil prices or energy prices, as they did in the old days. This time we've seen the opposite. Oil prices have come down, which actually benefits consumers around the world. So one of my worries is that the geopolitical tensions continue, intensify, and at some stage may actually lead to disruptions in the supply of oil, and then oil prices shoot higher. So that's the first risk I worry about. The second risk is, and this may sound a little bit strange, but I think a major risk is that the US economy becomes too strong next year. Right? So if we see economic growth in the US accelerating,
3% plus?
I think 3% is probably not, but if it goes to say 3.5%, or maybe even more than that, I think that's a risk, because this would push interest rates higher.
Yeah.
This is what would get the Fed going earlier. And then we're talking about the negative impact from higher US interest rates on the rest of emerging markets, which we discussed earlier. I think that's the second key risk. And then the third risk is it's about the unknown impact of the deleveraging and the transition that is happening in China. Right? We think this is a controlled slowdown. We think China will be able to deflate its credit bubble gently, but we don't know for sure. So I think one risk is that China slows too rapidly, and then you get a major negative knock-on effect on all those countries that export to China, either commodities or consumer goods.
As we wrap up, just a couple of questions on India and how that market would stand out. Do you think growth numbers would pick up in India?
Yes, we think so. So we think India is one of the few large countries that can see an acceleration of growth next year in EM. So we think Indian growth will probably go from 5.3% this year to something like 6.3% next year. Right? And the main reason is that inflation is now coming down. Interest rates have come down. We think the RBI will cut rates once, maybe even twice from here. And I think the reform program that will now gradually be implemented helps to raise business confidence. So this is something that will help investment spending.
My final question then, do you think that the risk for India in 2015 is more internal or more global linked?
I would say it is now more internal. Last year the answer would have been the other way around, but there has been adjustment on the external balance, so India is now less vulnerable to external shocks. It is still vulnerable, but less so. I think the main issue now is whether or not the reforms will be implemented and at what pace. So I think the main risks are internal.
And we hope India continues to stand out among emerging markets in 2015 as well. Joachim, thanks very much for taking out the time to speak with us today. Well, with that, we come to the end of this edition of Global Mantra Market Outlook 2015. Catch you with another special guest next week. Till then, take care.
If you come to really a description of the US equity markets, one thing is very clear. It will not the phase for multiple expansion. It's over. It's a period where the equity markets will drive by earnings. And I think that we can also expect further, multiple compression here. But even though that not means S&P 500 will negatively impact, I think in this period, the stock indices can go up like S&P, and we are expecting a modest rise, not a modest, normal rise, earning driven, dividend driven, around 7% for next year.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.